Okay, we're going to go ahead and get started. And to start us off, I'm going to hand it over to Zach. He's going to go over some of our new indexes or indices that have just been added and explain how you can look at them, how to find them. And of course, at any time, if you have questions during the webinar, please click on your Q&A little icon there and type in your question, and we'll get to it as quickly as possible.
Good deal. Thank you, Brad. So we have added a slew of economic indicators this week. For those of you that are unfamiliar with economic indicators, that's not a big deal. We didn't add the entire BLS and Census Bureau and government databases. We added the ones that we think are the most pertinent to trucking. I'm going to go through those in brief. I don't want to turn this into an Econ 201 class. Sat through one of those before, didn't quite make it all the way to the end of every one of those. So I'm not going to turn that into this, but I am going to introduce you guys to a lot of what we're trying to accomplish with these, which I think is more important. We've kind of narrowed it down to the ones that are going to make it easier for you guys to make decisions on your day-to-day. So I'll go ahead and start off with the one that I have pulled up right here, which is the Producer Price Index for long distance truckload. And what this particular index is measuring is pricing increase, decrease versus a base year, whether or not you're seeing rates go up or down along the truckload market. So what they've done here is they've gone out and surveyed a bunch of companies and said, okay, here's their rate levels today. In a year, where are they at versus like a 100 base. So right now you see that it's at 133. That means that it's about 33% better than it was in the base year, which I believe is 2012. But I do have a full description of these listed on the SONAR website. So again, any of these indices that you have questions about and want to do further digging on the SONAR website. So you can go out there and get a little bit deeper with them if you'd like. But essentially this is measuring how much pricing is going up in the truckload market. So as you see, 2017, since the end of the year, we've come up quite a bit. So we already knew that rates have gone up. But this kind of gives us a good way, especially on a macroeconomic level, of how much they've gone up. So you can see that they've gone up 7.59% about over the last 17 months, 9.43 points, and that's an index. So that's not necessarily representative of an actual price, but it's an index. So we've seen this pricing strength increase dramatically this year. I think everybody knows by now the freight market's destabilized significantly at the end of 2017, but a lot of those rate increases did not go into place until 2018. So this is just more validation of that in general. Now, we do have 4 versions of this. The PPI LDTL, which is the truckload, the PPI LDLTL, which is the less than truckload producer price index, which is more of the same of what you've seen with the TL. They generally move in the same direction. So LTL has actually taken a pretty good, probably a lot more of an increase. I'll go ahead and drop this trend line on here so you can kind of quantify. I think I put it about right here for truckload. So yeah, LTL has increased about 10% over the last 18 months. Again, these are just good, solid backdrop measures for kind of gauging where you're at. Like if you've gone out there and given rate increase of like 3 or 4% in the last year, you can tell right here that you're probably behind the curve. Especially if you're a carrier. Shippers, if you've only gotten like a 2% increase, that means you've had a lot of purchasing power. Let's see, we've got a few other PPIs right here. The general freight, which this encompasses all of trucking. Again, these are producer price indexes. So they're basically measuring the prices throughout the process of trucking. So basically your carrier prices are going into this process along the entire supply chain. So yeah, more of the same. See, general freight trucking has come up quite a bit, and actually it just started increasing even more. And well, no, I'm sorry. It's come up. It's following the same trend lines as the others, and that's a lot of what I would expect to see throughout. And we have one more local, which is the local delivery, kind of your last mile. This is how it's relevant to e-commerce. So you can see here that we've had a pretty big resurgence in local pricing, as it's come up quite a bit after a big shortfall here in 2016. Rates came down. It was a lot more sensitive, which I think this is interesting because it appears that the local pricing is a lot more sensitive to economic downturns, which we had a small version of that in transportation in 2016. The economy itself did not go down. Again, these are indexes they're important for us to kind of look at when we're taking a step back in the big picture. So when you see that your daily outbound tender rejection indexes are moving in a certain way, you have something that can kind of back that up and validate it in the bigger market. We've got a few more of these economic indicators to go through, and I'm not going to sit here and go through each one individually. I'm just going to give you a quick rundown. We've got the goods export, good import. They're both year-over-year changes. So what that means is you can look at each one of those as they were in comparison to last year. Go XG. Sorry, if I can type. And they're both available in the USA granularity. There we go. Once I figured out how to type. So what this is telling me is that exports year over year out of America have increased 13% since this time last year. So that's a pretty big increase. And then of course, you can't look at exports without imports. Go MG. Again, all these are listed on the SONAR site. I can get this chart to show up. There we go. So imports have only increased 8%. So our trade deficit continues to expand a little bit. Again, both of these are important in relation to each other. I will not go into all the economic significance of currency markets and all that, but we do have quite a bit of these that can give you extra data points when you're trying to make your day-to-day decisions and say, like, you know what, this is like indicative of the overall economic movement. So anytime that, you know, you're sitting in an office and you're trying to do some forecasting, financial analytics, maybe presenting an ROI for you brokers out there and trying to judge revenue growth and whatnot, you need to know exactly what the market is doing in the broader picture, because transportation, unfortunately, is driven by a lot of other sectors of the bigger economy. Retail, for instance, has a huge impact on trucking. So I think everybody knows that's been in transportation for any period of time. Retail really drives a lot of trucking activity, specifically in the holiday season. And for that, I'm going to transition right into the retail sales, which was just released this week by the Census Bureau. So what this is telling us is that year over year, retail sales has gone up 6.45% versus this time last year. That is a tremendous amount of retail growth. And just to give a little bit of perspective, because I know I'm not overly familiar with all of these myself, but I do know that anything over that of inflation in terms of growth, percentage growth, is generally, it means that there's a lot of, there's more of it than just standard inflation. Again, 6.45%, we're running at about a 2% inflation. I just Googled that this morning, so it's not like I have all this background information. But again, it's sitting at about 2%. So retail sales is a measure of dollars, and they take out taxes, but they do not adjust for inflation. So you've really got about 4.45% of actual intrinsic growth in the retail markets. Now, the government will break that down into various segments. They'll give you a little bit more granularity. And actually, one of our writers, we tend to cover these every month when they do release them. Ibrahim, for those of you that listened to our webinars last week, gave one with Craig Fuller, and he's our economic analyst, and he tends to write an article every week, or every month, about some of these more important economic indicators and how they pertain to freight markets in general. So this is a good way to kind of, you go check your FreightWaves, and then you go look at the chart, and you start to understand some of this stuff a little bit better, and it'll probably help you make better decisions in your day-to-day. Again, this one in particular intrigues me because it's kind of just validating the fact that we know our economy is getting stronger. Right now, people are still out spending money regardless of the tariff talks and all some of this somewhat negative information we're hearing because of the global trade situation. You should not feel that right now, especially in June in the retail markets. Looks like consumers really just don't care right now. Now, as the costs get passed along and the tariffs get further implemented, I would expect that to change a little bit, or maybe people just have more than they need and they decide to stop spending. I don't see that happening, but right now things look good. So if I were to go out and just to give you guys a quick use case for some of these measures, I go out and I see that the spot market is on fire. I look at my OTRI. OTRI shows that my turn downs, my tender rejections are elevated. I'm seeing my tender lead times going higher and higher as the shippers realize I need to put my loads out there further and further in advance. What's going on out there? And then I go and I see some of these economic indicators. I look at my retail sales and I'm like, oh my gosh, retail sales last month was 11%. The economy's kicking. This is not some sort of short-lived event. I now have validation for what it is I'm seeing, on my load boards and in my office. It's not that we're just doing that. Maybe we're trying to figure out if we're doing something special or not. And it looks like, no, we're not doing something that special. We're actually just growing along with the rest of the economy. And that's important information to know, especially in the financial sector. Let's see, what's another couple? Let's see here. I'm going to hit for the complete list. I'm going to keep reiterating that our website has all of these listed with a little bit of detail with them. It's not going to teach you Economics 201, but it will kind of give you an idea of kind of some baselines of what it means. I was talking to our economic analyst about how to really explain and understand some of these. And he kind of gave me some perspective, and he says, most of the time, you want to just find what's normal and what's abnormal, and you give that baseline for what makes the most sense. So for me, knowing what inflation is, for instance, helps me kind of understand what that retail sales percentage is. And also the producer price, you can relate that somewhat to inflation. So anything over that of inflation will kind of let you know that's how much things are increasing in relation to that general inflationary number. So right now I've got the industrial production year-over-year change. Now what this is it's basically a measure of output in the industrial sector of the economy. Manufacturing, oil and gas production, things like that are built into this. And so it kind of gives you an idea of the output, not necessarily in volume and in dollars, I'm saying, but in volume of output, like how many widgets are we producing this month. When the industrial sector is kicking, that means that demand is probably pulling the economy along. When it's slowing down, that means that demand has probably fallen off a good bit. So that's a good leading indicator of what the economy is preparing to do. Sometimes, a lot of these economic indicators are not necessarily leading indicators. They're lagging. And what that means is if I look at industrial production this month and maybe GDP this month, industrial production may show a downturn and GDP shows an upturn. And I think most people understand that GDP, gross domestic product, is kind of the measure, the benchmarking measure for the economic situation. We do have GDP in here as well in terms of a growth number. It's real GDP for the economists out there. But GDP is kind of what we decide whether or not we're having a recession or a good economy. So a GDP of about 2% year over year growth, that's a pretty good economy. GDP of about 6% means we're in an overheated economy. And back to my original point of the industrial production, if you have a lower industrial production and your GDP showing up high, that means get ready for a downturn. So that's what I mean by leading indicator and lagging indicator. GDP is somewhat lagging in the way that it's reporting what has already happened, because these numbers don't come out at the very end of the month. They come out a few weeks or a month later as they refine the numbers and all that kind of stuff. So how does this relate to my freight and what's happening there? Well, all of these kind of help you paint a better picture of what's going on in the overall economy. That's about all I'm going to say about the economic indicators today. Obviously, if you guys have any further questions or whatnot, check out the website and send us messages, ask us questions, anything like that. Brad, you got anything?
Yeah, I think I was gonna kind of ask you to further explain, which I think you did. I think the questions we get is, okay, I see the use of the tender rejection indexes, and I see how those can help me on a daily or weekly basis, but how do these economic indicators help me or us in decision making? And I think the term is validation, I think is a good term to use, and that you can better understand that this isn't, a fluke, reaction to something in the market, that it's showing that we can expect these trends to continue for, some amount of time, or is that kind of the right thinking that our users how they can view this data? Because I think that's a question that we'll get a lot of the times.
Yeah, no, that's exactly right. I think what we've got is basically just one more data point, or several more data points actually, that will validate any kind of analysis that businesses are doing. Carriers, brokers, shippers, analysts, people outside of transportation. Actually, this kind of can pull them in, because I think when a lot of companies are out there kind of developing their own internal processes, a lot of them, I was guilty of this myself in a previous life, where you forget that there's a whole big world out there that has nothing to do with you. And what these do is kind of help you connect what's happening in your world versus what's happening in the bigger picture, the broader economy. We can all get stuck sitting in our chairs, evaluating our day-to-day life, doing our singular appointed tasks, booking freight, managing drivers, ordering shipments, all these day-to-day tasks that we do. And sometimes we need to take a step back and take a look at the broader picture to see what's going on, because maybe some of this stuff connects to points where you're like, wait a minute, retail is slowing down. That's why I'm not seeing as many shipments. Maybe that's why I'm not getting as many orders. I mean, because a lot of these things, everything's connected in this economy, and so there's always something else out there that you could know that will help you kind of do your job better, or for any other growth whatsoever. It's always good to have more information versus less. I'm going to pull up one more economic indicator just to kind of hopefully drive this one home. Then I'm going to move on from the indicators for the week. I
was just going to say one more thing. I think that's what we're trying to do, not only with the economic indicators, but SONAR as a whole is to help our users think externally to, help improve themselves or their operations internally.
Yeah, no, and that's truth. We want this tool is designed to help people start kind of, getting this external source of information, helps you kind of evaluate yourself better. Everybody has their own way of evaluating themselves, and this kind of gives you a way of benchmarking yourself against the rest of the world or the economy itself, and in the country. And just to drive that home one more notch, this total business inventory to sales ratio. So what this is a measure of the volume of inventories available in different shipper warehouses across the country versus their monthly sales at the end of the month. So if they have $100 worth of inventory sitting in their warehouse, and they sold $50 of retail of sales that month, they have a 2-to-1 total business inventory to sales ratio. So effectively, what that means is they had 2 months of inventory sitting in their warehouse. This number is a lot more telling than you may actually think. I am going to zoom out here to drive this home. So you see back here in 2009, I think everybody knows about the Great Recession, where we had a couple of quarters of consecutive negative GDP, just to tie back in the GDP number. So everybody has a point of reference, because 2 consecutive negative growth quarters of GDP generally equals a recession. There's other things that the government takes into account, but I think when the housing bubble popped or burst back in 2008, you see this skyrocketing inventory level. They went all the way up to almost 1.5 months of inventory available in the warehouses. When you see this thing spike, that means that demand has slacked off rapidly. So customers aren't ordering more, the warehouses are backing up, and they haven't got the message yet, is basically what this is saying. Is shippers kept shipping stuff, but they didn't know that nobody wanted their stuff or didn't have the money to buy their stuff right then. So this total business inventory is actually a really good leading indicator of what's happening in the broader economy, because the shippers they don't have the idea about how demand has slacked off in the economy yet. They just keep going about their day to day. I'm going to keep tying in this idea of you got to know what's going outside your house to understand what's going on inside your house, because you could sit there and make widgets all day and wait a minute, the message didn't get back to my house that I need to stop making widgets because nobody wants them right now. Inventory's back up, and therefore demand has slacked off. So you see right now we're looking at about a 1.34 total business inventory to sales ratio, which historically is pretty healthy. I wish I could give you a magic number that said that this is where the healthy number of inventory is, but there's not really one. What I can tell you though is you can see here, 2016 inventory levels started climbing up pretty significantly over a short period of time. In 2015, there were signs that the economy was slowing down, and it did for a little bit of time. But then middle of 2016, shippers obviously got the idea that we needed to slack off and not ship as much. And they've managed to figure out, and also the sales cranks up again. So that's going to deplete the inventories as we're seeing right now. Anybody needs a use case for this, just look back here at 2008, 2009. You can see inventory shooting up real fast is probably not a good sign for the overall economy. So on that note, we'll move on. And just to let let everybody know out there, we're kind of bypassing the SONAR 101 training in these webinars for now, moving forward. So, but it doesn't mean that we're neglecting the new users. We've got a bunch of other tools available on our website now. Brad, if you want to chime in and let them know what they can do.
On our website at FreightWaves.com, under the SONAR link on the top ribbon, we have an explanation of every index available on SONAR. We have, we're telling you how we're getting it. We're telling you how often it's being updated. We're also providing these weekly webinars that are posted there, also market updates that are every Tuesday. And we also have, I believe, our index definition. So as you originally may be a little confused on finding some of these newer tools, all of the definitions are listed there, and there's a complete guide to see what all those mean as well. And this screen is also accessible through Sonar, through the dashboard in the top right corner there. Under your name, the drop down, the knowledge center, you will be able to find a link to all of this information if you just click on the knowledge center.
Cool. Yeah. Because I don't want to. I know there's some out there that may be like, whoa, what are you doing? You just skipped all of our all of our basic training, and that's because we're trying to kind of build this out and make sure that everybody has some of these continuous users have a little bit of content to go off of as we introduce more and more into the Sonar platform. We're trying to do something new just about every week at this point. So this thing is growing tremendously. There's a lot of new data points and in the future and stuff like that. So what we're trying to focus on at this point is kind of keeping that pace going. We don't want to ignore the new users, but this is going to be a good kind of tool, I think, even for the 101 user to kind of see what we're doing and how we're developing this product right now moving forward. So with that being said, we can move into a little bit of some market analysis. So this week, I think we've talked about in the previous weeks that we had, we were seeing a good bit of softening in the marketplace. You can see here since about the end of June, tender rejections are actually going down. We know this is happening. It happens every year. June has this big surge. Shippers are pushing freight out into the environment so that retail can increase their sales 6% year over year. So then they take the week off into the 4th of July, and it takes them about a week or two to get back going again. So right now we're still seeing the market kind of act in a softer manner. You see the tender rejections have dropped about 500 basis points since the end of June. You see right here, though, that things are kind of, they're not falling as quickly as they once were, which again, this quick falling is something that if I'm out there in a broker seat, I see that spot rates are probably about to soften because just to give another quick definition of tender rejections, what these are, they're measuring tender, like load tenders as they come over to a carrier. The carrier's saying yes or no. We want this, we don't want this. The more often they say no, we don't want this, the more often they are playing. They're probably either don't have capacity or they're putting their capacity on the spot market itself. So when this is happening in the broader market, I'm paying attention to my rates. I can still take advantage of charging a premium to an extent on the overheated market, but I have to be mindful that is probably softening up. But I also don't have to worry about turning around and going to my carrier and him charging me 10% more than he did last week. Again, you can go into individual granularities of the market, like I'm going to show you here in a second. Something that we found today that we were actually expecting and waiting on. So when you go into an individual market, outbound tender rejection index market, what outbound is obviously is the origin market for the loads. Probably the most easy or the easiest thing to understand in terms of concept of outbound load rejections. Inbound is more of a generalized avoidance of an area as opposed to kind of a commodity flow, shipper specific, region specific type area. So outbound tender reject index for the Los Angeles market has now taken a big jump over the last week. Go ahead and make this a little bit more volatile. So we see that the LA market, I'm going to change the scale a little bit more to make it more relevant. So June, everybody in the month of June was operating at a pretty elevated level. So I think everybody now can see what an elevated outbound tender rejection index is for the Los Angeles market because rates skyrocketed in the month of June. just about all over the country. I know we got reports of van rates increasing significantly. We report that on our, on our website as well, not necessarily in Sonar. We're not a price reporting tool, but what we know about June is that it was a very active month in the spot market. And June ended and everything kind of cooled down and settled down. You see this big drop in tender rejections right after the 4th of July in the LA market. It dropped about 21% over the course of a week and a half or so. And now over literally the last day, you see this big increase in tender rejections. Now this is significant, and the reason you know it's significant is because you can look here at the percentage, 12.84% for that market. That's significant. Anything over about 10%, you can bet there's something to it. We were wondering who would start first in the marketplace, in the freight markets. We know that it cools off in July, but it doesn't stay cold forever. Obviously, it could have if it really wanted to. And again, we only have one day, so we can't draw any major conclusions with one day. But we do need to actually seriously pay attention to what's going on in LA right now, just because we have actually been watching the LA market due to this index that I'm going to pull up right here. For those of you who aren't familiar, this is the FreightWaves Baltic Exchange Index. So we've talked about this in previous webinars and on market updates and stuff like that. And what this is doing is measuring spot market activity in the container shipping. So if Maersk is shipping containers, 40-foot containers from China to the North American West Coast, that's what CNAW means. We have about 16 of these lanes. Obviously, the ones that are most pertinent to our audience are going to be the ones that are moving to North America. And I think everybody is up on the whole China-North America situation, but there's also Europe and a few other areas involved with all this. So if trade kind of degrades between China and North America, it doesn't mean that we're not going to have a need to import stuff. It means that we may need to find other places to get it. So the FreightWaves is a good place to see where some of these volume surges are and what happens with the freight when it comes into the ports. I think that's what I'm trying to drive home here is once this freight moves in from China, it hits the ports, and it'll take a little time to kind of start hitting the ports because it takes 11, 12 days to get over across the ocean, Pacific, I believe. Hits the ports get busy. They contact the freight forwarders, and shippers are like, where's my container? They start shipping out, and it takes a little bit more time before you start seeing capacity kind of sucked out of the market. One of the things we weren't sure about this one is this one had such a rapid increase, and it didn't really make a lot of sense that it would happen literally the week that the tariffs were implemented. So we weren't really sure what this was indicating, but it looks like now we might have an explanation. Some of these shippers might be in a more of a excited state with all the trade talks with Trump, getting on his Twitter machine and making some of these statements and going and visiting Putin and being buddy with him. It looks like the price of containers has really come up over the last 2 weeks. So the next thing you got to look for is what's happening in the two biggest ports in the country, Los Angeles and Long Beach. We didn't see anything last week. We're just now starting to see something. This freight, as it comes in out of China, is then distributed across the country. So Los Angeles capacity, they don't have visibility. Nobody's looking at container ships coming across or not very many transportation companies are looking at container ships coming across the Pacific. They know they're coming, but they have no idea when this volume is going to hit. They don't know how much of it. It could soften, it could not. There's not a lot of visibility there. This FreightWaves gives you an idea of what they might be seeing. we actually thought this might be one of those situations where carriers were grabbing a little bit more revenue as they take capacity off the market. Now we have some sources that told us that, yeah, there is a little bit of capacity coming down, but that doesn't necessarily mean that, I mean, nobody's going to go out there in a low demand situation and spike the rate that much without reason. So I think we're actually starting to see the front end of some of this container volume, which is everything from food to electronics, you name it. Look at just about anything that you purchase. Most of it says made in China, made in Taiwan. The phones that we carry, they don't get assembled here. So a lot of these guys might be just shipping stuff over, trying to get in front of any future tariffs. And the Freightos is a good place to look to get a head start on what that might mean. So we also have not just the North American West Coast, and you saw the outbound tender rejections in LA, but we have, and this should happen, I don't know, at a little bit bigger lag. So China also ships to the East Coast. And what do you know? We have a big increase in the China to East Coast spot container rates. So the next place I'm going to go, where are the big ports on the East Coast? First stops are generally like Houston or New York, but there's a lot of other stuff going on in Houston and New York, like oil. And New York obviously has a lot of European freight, and just it's New York, Savannah, and Charleston, the other two ports. We can see here their tender rejections, unlike the rest of the country. Something I'm going to drill in on here. So what I did was I put up the outbound tender rejection index for the United States in comparison to the Savannah market. You see how they are diverging from each other. So whenever you see this divergence or a convergence, that means that there's something significant happening in that market. And that's what we're seeing in Savannah right now. We're seeing a divergence from the rest of the overall marketplace as tender rejections continue to kind of soften in the rest of the country. Savannah and LA, and I'll throw up LA real fast just to give perspective. It might throw off my scale a little bit here because they're kind of spread out. Not as bad as I thought, but you can still see that divergence as they move away from each other. This may look like it's moving towards some,
but they're increasing.
Yeah, but they're increasing. A better use of that might be our OTRI-W, which will actually give you a better idea of how things are moving.
This is the weekly change.
Yeah, go ahead and talk about that while I type these up.
So the outbound tender reject index weekly change is one of our time series indices, which, as you may be able to tell from the name, it's showing calculated the same way as our tender rejection indexes day by day, but just showing the past week and how it's reacting on a percentage basis. So up 1%, down 1%, or in this case, looks like a couple of them are a fraction of a percent change.
Yeah, and since these movements are so new, it's showing a negative percent change week over week in the LA market when it's not really. Like this is literally happening in the last day. That's how near time this is. So shippers, carriers, brokers alike should be all about this, kind of initial indication of what the ports are experiencing right now. There's probably a good bit of opportunity sitting out there.
And do you want to jump back to the LA market and talk about and look at the
my
tender.
Amazon order? It was Prime Day yesterday. I don't know if a lot of people knew that.
And look at the tender lead time actually.
Oh yeah, it's a good point.
See how I know we talk about the tender rejection indices quite frequently, and this one is actually derived from essentially the same data. So a very, very accurate data set with a lot of data points put into it, and just kind of talk. I mean, that's a pretty significant increase in tender lead times. And I know for some of our users that may be familiar, we've said, tender lead times can tell you a couple different things, whether they're increasing or decreasing, but it's the volatility you want to pay attention to. So I know we just pulled up the outbound tender rejection index showing an increase in tender rejections, and we showed an increase in container volume and into the LA port. So what is this tender lead time telling us?
So tender lead time works really well as adding color to what the outbound tender rejection is. So what the tender lead time is basically a shipper puts out an order 2 days in advance of pickup. That's a 2-day tender lead time. So when you see lead times increase over time, that tends to mean that shippers are having to be more proactive with scheduling their loads. Because they want to make sure that capacity is available and they're not paying a premium. If you're trying to book an airline flight the same day that you're flying out, you're going to pay a premium for that flight. Mm-hmm. It's the same in trucking, and that's what tender lead time is effectively measuring. Is like how willing are you, or how sensitive are you to avoiding that close, like that near time upcharge of booking your load. Mm-hmm. And you see here in Los Angeles, so you combine this with what we know about the tender rejections, you know that shippers are already feeling this tender rejection. So they're basically rejected and they feel bad about it. And so they're putting their loads out there a little bit earlier just to make sure they're not getting rejected as much as they are. When this happens at the same time, you can tell that this is an event that's happening like with significance, and it's fast. Mm-hmm. So we typically don't see tender rejection or tender lead times go up with this amount of volatility. What I also wanted to do in conjunction with this is I'm going to pull up the national tender rejection or tender lead time, sorry, tlt.usa. So what I'm going to do is I'm going to pull up a few different markets. LAX, who we're picking on right now. I'm going to say tlt.atl. Atlanta, it's a decent freight market. And then tlt.chicago. So I just kind of wanted to illustrate that you can see there's almost a normalcy in each market about tender lead times. They all have their kind of humps. They move somewhat with the market itself, but they all have kind of this normal tender lead time line. And without throwing up some moving averages, because I think that the chart itself will get a little bit hard to read, but you can kind of see like everybody kind of stays in their lane. Some of them move more closely with the national tender lead time than others, but LA tends to have smaller lead time in their market. And that's somewhat surprising to me, considering that LA tends to be a more volatile marketplace. People go in and out of LA all the time. It's a huge hub of freight going up and down the I-5 corridor and obviously coming east-west. So there's a lot of volatility there, a lot of market activity. I would think that some of these lead times would be significant. So as you can see here, the tender lead time in LA is nearing as high as it's been for a long time. Certainly as high as it was in June when things were at their most significant. If I pull all the way back out, you can see, here we go. That might be a little hard to read. I might have actually thrown up too much information on this one, but you can still see that the tender lead time in LA, I'm going to take off some of these. I think you get the point. For LA is operating at an all-time high. So you know that something significant is happening in LA right now.
Yeah, and I think the movement is what's important to look at, and to see that whether it's 2.25 or 2.75 days, every market seems to have its normal average, and to see that, that outlier or that change from the norm of how it usually ebbs and flows is what you want to pay attention to.
And I don't want to throw too much at our audience today, but there's studies up here that you can use to actually tell you what's normal and what's not. And it means that you don't even have to know what 2 2.25 is, but you can wrap some of these studies around it and it'll tell you just exactly what that means. So you could probably see here, we had a pretty significant deviation from the average right there, and then it shoots back up again. This is a very volatile market that we're looking at right here. That it's not typical. Right through here, you can see this stability. I'll go
now
ahead.
You have to throw it up. People are interested.
Yeah.
It's almost 250 if they're still on. They're clearly very interested.
Yeah, right. So, right. No, I teased it a little bit, so I guess I will go ahead and throw it up there. So, all right. Not really. So I'm going to go ahead and throw up this tender lead time. Now, this is not a great use of this particular study itself, but what can I throw up on this one? Moving average envelope. So there you go. So all this is doing is giving you kind of a moving average in this middle line right here. Up here is a standard deviation line, which standard deviation is basically saying here's so much distance between this space and the average. More volatile things are going to have bigger bands, bigger lines. But if you kind of want to see this normalized field right here, there's a certain percent above and below the moving average. This is not a standard deviation. I'm sorry, I misspoke. This is an envelope. So all it's doing is taking a certain amount of percent above and below the moving average. So anytime it goes above, a certain percentage, which I didn't specify in this one, you can see this is significant. And you see now anything poking out over here is significant. And we have multiple studies that we'll get into someday, but I think that might be a little bit advanced for today. I'm going to pull back a little bit here, take off the envelope, but I think just to kind of illustrate the power of this tool, I think it's important that people know that there's a lot more to it than just simply charting information. Like there's a lot of data points on here that even it took me a little while to understand and wrap my head around, but once I did, it didn't take that much time. And some of these visual tools are very useful in kind of giving you that point of reference to understand what some of this data means, because we can't all be statisticians.
Right.
And I think that's the point of SONAR, is to help us all not have to be statisticians.
Exactly. That's the hope and the plan.
There we go.
And we're going to go ahead and wrap it up here. We appreciate everyone stopping in, listening to the webinar, and we'll be back here again at 2 p.m. Eastern next Wednesday. Zach Strickland, our market analyst, and Brad Ganane, SONAR account executive, signing off. Thanks, guys.
Thank you.